biggest mistake that I see investors make with delta neutral strategies is not that they didn't set them up in the first place, but rather that they do not set them up properly to actually hedge out full market exposure. They end up setting up pseudo delta neutral positions, which only hedge a portion of their market exposure, meaning that when markets get super volatile, either going down a ton or going up a ton, ultimately their hedge fails and either loses money or, of course, does not cover enough of the position loss. So today I'm going to reveal my exact strategy and framework for setting up delta neutral positions. And I'm going to show a case study that has allowed me to earn 134% APR on a delta neutral strategy. Let's dive in. So with that being said, the first thing that I want to break down is delta neutral versus pseudo delta neutral and the difference. Ultimately, delta neutral means that you are perfectly hedged, and that goes into a saying where you are hedging out your delta. Your delta is obviously your exposure. So fees and yield, that's not going to be factored into whether you're delta neutral or not, just simply your principal capital or your actual collateral. So if we have a long position, let's just say, and this long position is our liquidity pool, and then we have a short position, and this short position over here is, let's just say, an options contract, right? Well, then of course we'd be balancing these things perfectly and evenly, right? So there would be $1,000 over here for $1,000 over here, going complete opposite directions. So if this one makes $100, well, guess what? This one's going to lose $100. But of course you have that yield that you're generating. So again, delta neutral means that it is perfectly hedged. Now, unfortunately, we cannot do delta neutral positions with perpetual futures. And the simple reason why is because it is going to be too hard to remain perfectly hedged unless you have some form of algorithm. But even then, with an algorithm or a bot, you're going to have a lot of divergence loss, and you're going to end up rebalancing too much, and you're going to have a lot of fees. Now, with that being said, a pseudo delta neutral position is going to be very, very similar. Your goal is obviously to hedge out your market exposure, but in this instance, it is not perfect, but precise is what I like to call it. So for example, if we have a long and we have a short, and let's just say this long is once again our liquidity pool, whereas this short is of course perpetual futures. So we're just going short on a specific asset, right? Well, then ultimately we are not balanced completely evenly, but perhaps we have $1,000 over here, and then we have $1,000 over here. But then when our long, let's just say, makes $100, our short might lose $103, a little bit more than it's supposed to, right? Well, guess what? We're hoping that the yield made from the long position is going to outweigh that $3 difference, which, assuming we structure our positions correctly, it will. Right? Another instance, let's just say that our long, our liquidity pool, actually loses $100. Well, then of course this short might only make $97, meaning that once again we have like a roughly $3 difference there, and we're hoping that the yield that we generate is going to cover that. So it's pseudo delta neutral. It's not perfectly hedged, but it's the best that we got. And that's what we can do with liquidity pools, simply because if you know liquidity pools, you go from one asset to the other asset to the other asset, and you bounce all around. You might start with 50-50 asset split, and you might hedge 50-50, so 50% Ethereum, 50% USDC, or 50% Sol, 50% Ethereum, right? But then all of a sudden you got 60% Sol, and then you got 40% Ethereum, and you're bouncing around, and you have to rebalance your hedge. So just a little quick case study that I want to show you that this strategy actually works, and this is one of the positions that I was running, and now I'm ramping this up with more capital, double the amount. I deployed roughly $15,000 in here. Now this shows a $4,883 profit. Looks great. Looks like it made 32%. But let's dive into the actual nitty gritty, right? I put $15,000 up on the long position, and then I put $5,000 over here on Hyperliquid. Now, Hyperliquid is a place where you can go and execute longs and shorts with leverage, right? So I put 15 grand on the long, no leverage, and then I put 5 grand on the short, 3x leverage. So if we do the math right here, right, there's 15K over here, and that is no leverage. So obviously that equals 15K. And then we put 5K over here on the short, multiplied by 3 equals 15K exposure. So this right here became pseudo delta neutral, meaning that my total capital input was $20,000. But with that being said, I still was able to successfully hedge out my market exposure. I'm going to go ahead and move my camera. As you can see, I closed these Sol and AI16Z short positions. I actually got liquidated, and you can see I lost 1342 and then 2401. So if we add those together, that right there is a total loss of 3744 basically, which is less than what I actually made from my long position, which is good, but that also means that I wasn't fully hedged. So if we did go down, well, I'd see a little bit of an actual loss from going down. Now, I'd have the yield to outweigh that and all, but at the same exact time, you could see 3744, and then over here on this long position, we made 4,100 bucks from the assets rising, which means if we do the math over here, we actually made a couple $100 just from the price appreciating, about 364 bucks. And that is because I got liquidated, right? Ultimately, what happened is the price started going up, and let's just say I got liquidated right here. The price continued to go up past my liquidation. So I actually closed my short right here, and then I continued to make price profit on my long without actually losing money on my short, which is why I was able to make that a little bit additional profit. Wasn't on purpose, if I'm being completely honest, but it worked. And with that being said, yeah, I profited 365 bucks just from price profit. I also had 775 bucks in overall earnings, which obviously contributed to my overall profit of this position. And if we do the math, that brings my total profit loss to about 1140, still retaining this 134% APR, which is great. Now, very quickly, I want to show you the strategy that I actually use to ensure I remain delta neutral. First off, I look at correlated liquidity pools. So we use this tool called Correlation on Demand, and simply all you have to do is select a base asset and it'll go and find a bunch of assets that's correlated to it. So recently what I've been doing is looking at assets that are correlated to SOL. Now it's going to search the top 250 from CoinGecko, and I like to look at the past 30 days, mainly because I have a little bit longer term of an investment horizon. But if you wanted to be more active, you can look at the past 7 days or so. So if we look at 30 days, we scroll down this list, you'll be able to see stuff that's correlated. So there's stuff like SOL Render. That's obviously got a very, very close correlation. We could simply go in to SOL and Render with a wider range, hedge out our market exposure by shorting Render and shorting SOL. It's not going to be the best idea because it doesn't do that great of a return, but SOL PopCat most likely does because PopCat is a meme coin. There's also Dog with Hat, and ultimately that's a meme coin as well, most likely doing a good return. So we're looking for highly correlated assets with good returns. The second thing I do is I actually backtest. And this is one of the resources that we use internally, and unfortunately I'm not going to be sharing it today because we do keep some of this stuff exclusive to my DeFi legacy community. And that's also the same place where I personally coach people on a weekly basis exactly how to open up these positions, how to ensure that you are remaining delta neutral. We dive into people's portfolios on a daily basis. And additionally, you're going to have one-on-one coaching from my community manager, Cons. You guys know me. I'm not going to push it on you, but if you guys are looking for some support with your DeFi portfolio and you want to implement a systematic approach so you can stop feeling stuck and struggling, ultimately, Builder Wealth is the place to go. There's a link right below this video. You fill out a quick little application. Just make sure you're a good fit for us because we do limit the amount of people that we work with to portfolios that have above $25,000. But after that, you can hop on the phone with my team. We'll make sure that we're a good fit for you, and then we'll go from there. Anyways, with that being said, we backtest, right? So we put in, okay, what if this asset starts here and this asset starts here? Here's our allocation and here's the ratio that we're shorting, right? And then from there, we see, okay, what happens if price goes up to $22.50? Well, then our capital would now be $10,050, right? And then the price over here is the same. And then we could kind of see what that's going to look like. And these are just random number inputs, but we are back testing this thing before we actually enter. And that's the very, very important and crucial part. And theoretically, you guys could replicate that in a spreadsheet. And if you guys want me to make a full video on kind of the math behind this, feel free to let me know. So those are two things: correlation high yield plus back testing before you enter to actually make sure that it makes sense. This is the number one thing that people miss out on. They just dive in thinking that, oh, this thing looks great. It looks great on paper, but when you start to back test, it doesn't look so great. Now, the other thing is I like to overhedge. And I know that sounds funny, but if I am in something like SOL and AI16Z like I recently was, well, I actually overhedge on the AI16Z. So I might go in with 50% of each asset, 50% SOL and 50% AI16Z. Doesn't really matter the asset ratios you go in with. Obviously, you don't want to go to range. The reason why it doesn't matter is because you are hedging out your exposure. But if I'm going in with 50-50, I might say, well, hey, I have a little bit more of a bias towards SOL simply because I don't like meme coins, and I actually don't think AI16Z is going to do as well as SOL. I think it's going to underperform. Now, when the market's going down, like it recently has been, that's very much the case. Usually, meme coins are going to underperform while the market's going down, and they're going to overperform while the market's going up. Just how it works. So right now I wouldn't be over hedging AI16Z. When I was going in, the market was obviously going down. We were in that period where the market was kind of crashing, as you could see right over here, basically in these recent days. SOL going from 143 bucks all the way down to 105. I went and I shorted 60% AI16Z and 40% SOL. Ultimately, I'm still 100% shorted on the market, but at the same time, if AI16Z starts to go lower than SOL, so maybe SOL goes down, let's just say 10%, and then AI16Z goes down 15%, well, guess what? I now don't have 50% AI16Z in the liquidity pool. I might have 65% or something like that. So by hedging 60%, I'm front running that. I'm getting ahead of it. And I'm actually making a little bit of profit on the front end as we get converted from 50 to 60%. And then as we get converted from 60 to 65%, well, I don't have as much profit. I'm actually under hedged, but since I made a little bit of profit here and I lost a tiny bit here, that thing nets out. So over hedging helps me out in this situation simply because I'm saying, hey, we are remaining delta neutral, but at the same time, I am expecting AI16Z to underperform. And then here is my fallback option, over hedging AI16Z. Now, the cool thing about this is worst case scenario, fees are going to outweigh the difference if we're in this for even just a week. And that's because we are generating a 134% APR that I was in this position for. Simple as that. Very, very good APR. That's a high APR that's going to be able to outweigh any differences that we have. And that's the beauty of doing this with meme coins as opposed to something like Sol USDC, where you are constantly battling the market. I've seen strategies where they open up multiple Sol USDC positions or multiple Ethereum USDC positions at the same time, and they go in and they open up multiple hedges, and they have like 10 moving pieces. And that right there is not the way to do it. And the simple reason for it is because you're not going to be able to manage that as a retail investor without having some form of automations. And unfortunately, we do not have that tooling available quite yet. So what's easiest? Find correlated assets, something like Sol and AI16Z, which has been relatively correlated recently, doing a super high yield. The yield is high enough to the point where any difference in divergence loss, any difference from one asset depegging from the other, basically, well, guess what? That's going to be made up in yield right there. And this right here has done the same yield, if not better, than stuff like Sol USDC, Ethereum USDC. And I know because I've tested different strategies out. Guys, if you enjoyed today's video, drop a like, subscribe, notifications turned on, and let me know what type of content you want to see on the channel next. Peace out.